Jake Claver just dropped a bombshell I need to share with you immediately. The ultra-wealthy are finally stepping into crypto, quietly, strategically, and with surprising focus on XRP. But here's the part that should make your jaw drop. We are sitting in a world where 99.9% of humanity owns absolutely no XRP. Not a single coin. Let me put this into perspective. What happens when somewhere between 100 to 200 million new investors pour into digital assets over the next few years? Where is the XRP supply supposed to come from? And more importantly, what does this mean for the broader crypto landscape? These are exactly the questions I want to explore with you today. And believe me, I have a stacked lineup of XRP news ready for you. But before we get to all of that, we need to address this story right now because it's a genuine game changer. Jake shared a story recently about a friend whose cousin works as an Uber driver. One day he picked up a clearly affluent family, wealth obvious from their clothes alone. They were heading back to a hotel in Orlando after spending the day at Disney World. The driver overheard them talking in the back seat, joined the conversation, and learned that this family, connected to a major food brand you absolutely know and have consumed, holds a substantial amount of XRP. And it's not just them. Many of the ultra-wealthy are waking up to what's happening. Jake said he's been speaking directly with several very large family offices recently, groups managing enormous wealth, and they have started making significant allocations to digital assets, including XRP. Now here's something that should really make you pause. There are only around 7 to 7.4 million wallets on the XRP ledger. Think about that. 8 billion people on the planet and roughly 7 to 8 million wallets, and half of those wallets hold less than 100 XRP. Not exactly life-changing amounts unless price appreciation takes them much, much higher. But that's not even the key point. The people who already made substantial wealth, the families behind billions, have a single objective: preserving what they already have. Their goal is not to take exaggerated risks or gamble on volatile assets. They already climbed the mountain once. As Jake says, you should only have to get rich once. To them, crypto as a whole still feels like the Wild West. That's why 62% of family offices have zero interest in allocating to digital assets. But here's the flip side: 38%, representing around $16 trillion globally, are now at least exploring the space. That's $4 to $5 trillion worth of capital from people who built their wealth through high-risk ventures, successful companies, or massive exits. These are seasoned, disciplined investors. And unlike retail, they don't throw money into hype. They look for asymmetric hedges, assets that can preserve their wealth when traditional markets unwind. Jake explained that many of his conversations now revolve around hedging against potential losses from the reverse carry trade, stock market volatility, and bond market instability. They're not allocating billions into XRP. They're allocating enough to protect multi-generational wealth. And that mindset shift, away from speculative gambling and towards strategic diversification, is something regular investors will need to understand once price starts moving. His analogy comparing wealth to a tree makes sense. You grow a strong trunk, the core of your wealth, and from that trunk grow branches representing diversified hedges. If one branch takes damage, the tree doesn't die. Wealth preservation at scale comes from building something stable, then diversifying intelligently. This brings us back to us, the regular investors. We all hope our financial foundations can withstand a shock. When disaster strikes, the goal is to bend, not break. These wealthy families are preparing for multiple economic risks simultaneously. They're worried about the carry trade collapsing, stock markets plunging, and bond markets destabilizing. Their strategy? Position themselves with assets like XRP, Bitcoin, and other cryptocurrencies as a hedge. Not an all-in bet, just a smart distribution across assets that can protect them from inflation, volatility, and whatever unforeseen events the global economy throws next. Now let's look at the numbers that really matter. We're talking about roughly 7 to 8 million XRP ledger accounts, but the number of actual human beings who own XRP is much lower. People don't have just one wallet. They have exchange accounts, hardware wallets, software wallets, mobile wallets, you name it. One individual might have 4, 5, or 6 separate accounts. So when we do some simple math, the number of real XRP holders might be closer to 2 or 3 million people worldwide. And if I'm being honest, the real number might be even closer to 2 million. That means well under 1% of the global population owns any XRP at all. We are quite literally talking about fractions of a percent. When you walk down the street, go to work, talk to your friends, odds are none of them hold any XRP. You are the outlier. And the reason most people don't hold XRP is simple. They don't have the information. They aren't aware we're on the brink of a complete overhaul of the global financial system. They can't see that digital assets like XRP are poised to power financial transactions on a scale that's difficult to comprehend. Hundreds of millions, even billions of transactions each year, flowing across global networks. We're looking at the potential for tens of trillions, hundreds of trillions, perhaps even quadrillions of dollars moving annually through blockchain infrastructure. Networks like the XRP ledger, Ethereum, Solana, and possibly Bitcoin will all play roles, though Bitcoin isn't built to handle high transaction volume. This is the direction we're heading. Ripple, meanwhile, continues executing its strategy like clockwork. They just unlocked 1 billion XRP and immediately locked 700 million of it back into escrow. Last year, they did the same, unlocked 1 billion, returned around 800 million. They consistently use only a small portion, around 30%, for operations, while the remainder goes right back into storage. Stability, predictability, controlled supply. Ripple has been building the Internet of Value since day one, and moments like these validate that vision. Jake highlighted Ripple's partnerships as well. One major announcement came from CIMB, the second largest Malaysian bank. They're joining RippleNet and launching a real-time remittance service, initially sending payments from Malaysia to Australia before expanding to 15 markets. This is real adoption, a major bank building innovative financial solutions directly on Ripple's infrastructure. Let's jump to the Onando Summit. The institutions attending this event are nothing short of staggering. Citi, Swift, DTCC, Invesco, Fidelity, Pantera, Moody's, Coinbase, Bloomberg, Broadridge, JP Morgan, S&P Global, State Street, WisdomTree, Goldman Sachs, Bank of America, Societe Generale, Franklin Templeton, McKinsey & Company. These are not random companies. These are the titans of global finance, the power players shaping the world economy. They are all aligned on one thing. Tokenization is the future. Not optional, not experimental, inevitable. Ripple also partnered with RedPay, a global stablecoin and fintech company, enabling stablecoin-powered payments across markets, including a feature that lets users send crypto and receive Nigeria's NGN currency instantly. This is a big deal. Today's remittance system is expensive and slow, with fees averaging 6.49% and settlement taking days. RedPay's integration with Ripple offers near-instant settlement at minimal cost, at a time when Asia-Pacific is surging with stablecoin activity. The new feature supports USDC, USTT, Bitcoin, ETH, Solana, Tron, XRP, BNB, and more, all settled in minutes using enterprise-grade blockchain infrastructure. Yet another sign that Ripple continues embedding itself deeper into global payment rails. Meanwhile, European banks are making moves of their own. 10 major European banks, including ING, UniCredit, and BNP Paribas, have formed a company to launch a regulated euro-backed stablecoin in 2026. The company, Cavallis, will operate under an EMI license from the Dutch central bank. This stablecoin will function like digital cash, moving across blockchains but remaining fully inside the regulated banking system. This is traditional finance acknowledging reality. Fintech is moving faster, and if banks don't adapt, they risk becoming obsolete. Their strategy is clear. They want to reduce reliance on U.S. infrastructure and U.S. dollar stablecoins. Today, nearly all stablecoins are essentially digitized versions of the U.S. dollar. Europe, the UK, Japan, they've been sidelined. So now central banks are scrambling to reclaim influence. They see stablecoins as tools of monetary power, and their goal is to position themselves as the primary providers of wallets, custody, and payment services so that corporate payments and cross-border settlements flow through their networks, not through crypto-native companies like Ripple or Stellar. But here's the thing: once the dust settles, collaboration is inevitable. Even if banks try to secure dominance, blockchain innovators like Ripple are too far ahead in real-world use cases for them to ignore. Leadership is also shifting. Cavalis hired John Oliver Sella, former Coinbase Germany lead and Binance executive, as CEO. That's not a small move. This is a heavyweight entering the field. Now let's shift to market sentiment. HSBC's Max Kett recently discussed expectations for a year-end rally. He suggests the current dip isn't a sell signal, but a buying opportunity. The December Federal Reserve meeting is expected to result in a rate cut, likely a quarter point. Some speculate a half point, though that remains uncertain. But if rates drop, capital becomes cheaper, and money tends to flow into risk assets, including crypto. Max pointed out that the recent correction lacked fundamental reasons and mostly triggered temporary hedging. His short-term indicators, VIX futures, put-call ratios, and option skews, are all flashing closer to buy signals than sell signals. So where does this leave us? December looks promising for many traders. Sentiment is shifting upward. Roel Powell even argues that the traditional 4-year crypto cycle is evolving into a 5-year cycle. And with the carry trade unwinding soon, 2026 could be a particularly strong year for equities and risk assets. That said, we should still anticipate turbulence somewhere in the next 6 to 8 months. And with that, I'm wrapping up for today. Thanks for spending this time with me. I'll see you in the next upload.